Hello and welcome. Thank you for joining our Crittenden Finance virtual event. My name is Sarah Havlina, and I'm the editor-in-chief of our real estate publications at Crittenden Research. Today, you'll hear from three industry experts who will share valuable insights for our topic, Multifamily Crystal Ball, Predictions for the Industry in 2025, moderated by Vic Clark, Senior Managing Director at Lumet.
Thanks for having us today. We really appreciate Crittenden and them putting us together. I've had the privilege of working for many, many years with my two colleagues today, and I'll get started by just introducing them or letting them introduce themselves. Amy, good morning, good afternoon, good midday, good Thursday. Say hello and introduce yourself.
I am Amy Nicotra. Some of you may know me by Amy Morgan. I recently changed my name about a year and a half ago, but I've been in the industry for 15 plus years. I have specialized in multifamily valuations for the entirety of my career. So I'm a mile deep in multifamily, and I have me and my team have appraised thousands and thousands of multifamily assets. I've spent time at CBRE. I went from there to run the National Multifamily Valuation Group at JLL for a few years. And now I'm here at Collier's Valuation Advisory, where I run the entire South Central region for multifamily valuation, but of course, serve my clients all over the country. So that's a little bit about me. I'm your friendly appraiser, and I'll pass it back to you, Vic.
Amy, thank you. Just always a pleasure to work with. Y'all do a great job, and it's been a privilege to work with you for so many years. Ryan Norwood, say hello and introduce yourself. Good to see you.
You too, Vic. My name is Ryan Norwood. I currently lead business development and capital formation for Northmark Fund Management, which is the private equity investment management team at Northmark. Until recently, we were Morrison Street Capital. I also used to work with Vic at Lumet for a few years. I've been on the origination side probably for 10 plus years, typically originating preferred equity, JV equity, mezzanine loans, and now do a little bit of everything here at Northmark Fund Management.
Thank you, Ryan. Also a pleasure to work with and just a very insightful person for the industry. My name is Vic Clark. Been a production person most of my career. Out there slugging it out in this difficult environment with everybody else right now, trying to originate loans on behalf of Lumet. Been here 15 years and really honored to be there. We're like most trying to navigate what has been, in my personal opinion, some of the most difficult waters we've had to tread in the last 12 to 18 months. Not only the fluctuation in interest rates, but the political environment and honestly just the complete uncertainty. Couple all of that with some of the difficulties in the multifamily space. And let's talk about that a little bit right now. Amy, I'll get you started, but talk a little bit about the troubles that y'all are seeing, maybe touch on insurance and taxes and some of the other things that you're seeing out there right now.
Certainly. That's definitely one of the major struggles in this sector is rising expenses. We're seeing a bit of a trend in the multifamily space of ownerships moving towards self-management rather than third-party management. It's an interesting trend to see. I don't think we're going to see third-party management going anywhere in terms of an industry. There's always going to be a really good need for that. However, what we're seeing is a little bit more discernment in terms of, who's at the property, ownership being just a little bit more hands-on in the day-to-day of what's going on at properties, so that they're better managing expenses and spend at each asset. The best performing assets that we're seeing right now are those that are either self-managed or are third-party managed, but have really strong asset management on the ownership side. And so I think that's one of the ways that we're seeing a lot of folks out there kind of mitigating some of these rising expenses. We are seeing a little bit of an ease up in insurance costs, and definitely a trend towards ownerships using technologies and other things that help them mitigate their insurance costs. So things like monitoring systems, keyless entries, things like that are helping to mitigate insurance costs. So that's kind of an interesting trend. And then, taxes kind of are what they are, and they're very market specific. But there's certainly a pressure point in the industry. And then finally, of course, payroll expenses. We've seen really sharp increases in payroll expenses. We are seeing, as we've been in sort of an economic stall out per se for the last couple of years. We're seeing those soften a little bit, but not extremely. So.
Thank you, Amy. Thank you. Ryan, touch a little bit, and Amy, you can chime in too, but cap rates, I think we're all, I don't know, I guess I use the word a little uncertain every time an appraisal gets ordered as to where the cap rate's going to come out. But I know the acquisition activity, certainly the last 90 days, has picked up substantially. Ryan, are you seeing that? What are you seeing?
Yeah, I mean, I think we are starting to see, a slight move up in transaction activity, at least on the acquisition side. I mean, much of what we see in the pref equity space over the last few years in multifamily has just been recap opportunities, some good, some bad. I do think that, for us, obviously appraisal is a part of the process, but we're typically doing our own analysis and valuations. Looking at, you see cap rates that are at a negative leverage point. That's challenging from an equity perspective, and obviously still challenging over the next 3 to 5 years to really underwrite dramatic rate decreases that would lead to kind of cap rates coming down. So I would say we're certainly seeing opportunities though where cap rates are north of 6, and when you talk about older vintage multifamily, potentially even higher. Obviously, there are risks with the older vintage stuff when it comes to capex and operations, but I don't know. I don't know that 2025 is going to be dramatically different than 2024 as far as cap rates are going.
Thank you, Ryan. Amy, chime in on that.
Yeah, I agree. I don't think we're going to see a lot of cap rate movement in 2025 unless we see some really, really dramatic changes in the capital markets climate. If we start seeing some more dramatic changes in the capital markets environment, then I do think that there's a possibility that we could see a little bit of cap rate compression. I think everyone hopes we're not going to see cap rates go any higher than they are. Unless you're buying right now, then you probably hope that they are. But I think everyone's kind of expecting a hold steady for the moment. It's interesting, Ryan, and Ryan really can speak to returns and the equity side much better than I can. But we've definitely seen a lot of secondary market and tertiary market activity over the past year or so. And I think we expect to see that continue into 2025, where the returns are stronger, especially in some kind of secondary and tertiary markets that have really strong demand drivers. So they're attractive investment markets, but you've got higher cap rate environment, which is making, returns on the transaction or on the deal look a lot better than what we're seeing in some of these, big, hot primary markets. So interesting opportunity to explore.
Good point. Good points. I know, all of us were hoping after the Fed lowered the rate 50 basis points a few weeks back with some upcoming potential lowerings that we were going to see some substantial relief in rates. And obviously in the world we live in, which is the 5, 7, and 10-year treasury, we have not seen that. We've seen just the opposite, with rates honestly going from 370 on the 10-year up to currently at 440. So that has obviously created a lot of stress for all of us. Ryan, have you seen any relief on the your side with respect to pref and mezz and equity as far as the demand for returns with rates staying high?
Yeah, that's a good question. I don't know that we've seen, pref equity and JV equity returns haven't necessarily been correlated to, whatever treasuries are. So, the kind of opportunistic 20% IRR equity return, I think that's still a bogey for many. I think it's a little bit more challenging to hit that kind of return in the current interest rate environment. When rates were 3 or 4%, and you had pretty obvious positive leverage, it's much easier to hit those higher equity returns. I think, I've certainly talked to some folks who have dropped their equity expectations, and maybe even folks that were looking for pref equity returns in the kind of the mid-teens, and struggled to find quality deals and quality sponsors at those rates, are now looking to be more opportunistic and buy things at maybe call it a 15, 16, 17 as opposed to a 20. So I think there has been a little bit of a change in expectation just based on interest rates. And just to add a little bit to what Amy was talking about, I mean, our funds are certainly focused on smaller and middle markets. And one of the things that I think we've seen is we target geographic areas where we want to invest, is that just cost of living and in-migration, which are a big kind of predictor of future economic growth, have been stronger in some of those types of markets. Some of the lower tax environment, lower cost of living. So we certainly target smaller to middle markets for our investments. And I think, especially even saying the word tertiary used to be almost a negative thing. I think many markets, in the way that we can cover them now, tertiary, it doesn't mean what it used to.
Makes perfect sense. Yes. Amy, one of the things I know we wanted to discuss a little bit today was rents and where we think multifamily rents are going. Obviously, you and I being in Texas, we have what I consider, a huge drive with job growth, honestly, all over the state, and predicted to just continue to be robust. But yet, it doesn't feel like the rents are in line with what you might expect with that kind of demand. And obviously, talk a little bit about your perspective there.
Right. I think that we're going to see some rent growth coming. If you think about supply and demand in the multifamily space, there was a huge push in development from 2020 to kind of the end of about 2022. And where we're sitting now, all of those developments are still delivering into all of these major markets where this onslaught of new supply has been coming. However, if you look about 18 to 24 months backwards at new starts, they have dramatically dropped off. I mean, in many markets, they're 70% decreased from where new starts were in the early 20s. So I do think that we're going to see some better rent growth metrics coming just due to that drop off in supply. But what we need to see first is for that kind of egg to go through the snake first, and all that new product that's hitting these markets to be fully absorbed. And once that all gets fully absorbed, I do think we're going to start seeing some better rent growth, especially in the markets, to your point, Vic, that have great in-migration, great employment and new jobs. Definitely, markets that are driven by large sectors and are very diverse. So a lot of the Texas markets fall into that. Sunbelt markets, I think all the traditional, core top tier markets are going to see the same general trend.
Ryan, thoughts on that? As far as rents, and I think Amy's spot on when she talks about the new construction. I know it was easy to find equity for new construction 4 or 5 years ago, when values of the Class B and C properties literally skyrocketed and were rivaling the cost of new development in certain markets. Right? Talk a little bit about
Yeah.
moving forward. Yeah.
Well, I certainly agree with Amy. I mean, I think new supply is probably in any market, it's really the biggest governor on rent growth. And despite all the positives in Texas, it's also not a hard place to build, particularly, or it hasn't been in the past. So that certainly keeps the rents down. It's hard to say. I mean, part of it is, look, rent growth was pulled forward. You could say 5 to 10 years of rent growth happened in 2 years during COVID. So to some degree, there's a certain limit to what you can charge people, and I think a lot of markets have kind of hit that, and that's obviously been a squeeze on NOI, as that same concept doesn't apply to expenses. So I think one of the things that we look at, and this is more my personal opinion, I'm a little bit more skeptical of kind of a traditional value add play where you just are going to do cosmetic upgrades and push rents to quote unquote market. I think pushing rents for the sake of pushing rents is much harder than it used to be, or than it was over the last 5 years. So that just has to be a real consideration in the underwriting. And oftentimes we're probably more stable asset lenders or investors, light value add. I do think, though, that as we've seen a fair amount of opportunities where you look at relatively distressed owners right now, probably because of their existing debt. And back to Amy's point on management, maybe you had a huge national manager that had lost sight of what was going on or was not incentivized in the same way, and now there's a little bit of an occupancy issue. Those look like opportunities where an astute owner operator who is local can come in there and create value by leasing these back up, to 95%, as opposed to saying, hey, we have something that's already stabilized and we're just going to move rents. I think that's a much harder proposition.
Thank you, Ryan. I agree that I think that there is a concern about affordable housing. It's been around for decades. It's got to be reaching a peak, in my opinion, as we have not seen just a huge decline in the price of single family homes that I think was expected out there. I know there have been some reduction in rents in certain markets, but minimal. Not anything that makes a big enough difference. And as Amy mentioned, with the lack of new inventory that's going to come online over, say, the next 5 years, it just feels like there's this overwhelming wave of potential rent increases just lurking out there that may affect the markets. Do y'all agree with that?
I do think that that's coming. And again, kind of to touch on my original point, I think that we haven't seen a lot of rent decline in any markets over the past couple years. But what we have seen is a drop off in collections. And this a little bit harkens back to that. Properties that are being really well managed on site and asset managed are performing better. And certainly with COVID, we saw an interesting kind of political climate around, handling evictions and non-payment of rent and things like that. It's been very difficult for us as an industry to move past that. I do think that we're seeing kind of some light at the end of the tunnel in terms of, eviction courts kind of clearing up in a lot of markets where they had been really bogged down, the process being a little bit easier than it had been in a lot of markets. But I do think that collections will be a really big focus going forward, especially as we start to see some of that rent growth coming. So I think the real question is, one, will we see it come? And then two, will we see it actually realized on the property level? But I do think it's coming.
Ryan, any comments there?
Not particularly. I think Amy's kind of hit it spot on.
Talking about different markets, and Amy, with respect to what you're seeing, obviously y'all see a lot. Are are there any, for the benefit of our listeners, are there any markets that you would recommend, or any markets that are maybe oversaturated right now that you see out there and you're struggling with? Let's just say that.
Sure. It's a good question, and I hate to to bash on any location.
Right,
I think it
right.
really depends on it depends on your outlook as an investor and the boxes that you're trying to check in terms of deal metrics and things like that. I do think that we're going to see some markets that are going to have some particular challenges. For example, the Austin market has seen a huge amount of new supply. They did not see the kind of drop-offs in new starts that we saw in other major Sunbelt markets during the last few years. So I think the rent growth is going to come a little slower in a market like Austin. But in that market, you've got a ton of in-migration, huge growth in the technology sector. People like Tesla and SpaceX relocating headquarters there. So will that offset all of that? That's to be seen. But definitely still seeing really strong attraction to the Sunbelt markets, Phoenix, Dallas, Atlanta, still a really great performing market, Tampa, the Florida markets. Jacksonville remains a very well performing market. Charlotte and the Carolinas remain very strong performing. And then we're seeing a lot of great activity in markets like Kansas City, Tulsa, areas like that. So those are some of those like little smaller sized markets, but still have really great drivers that are performing really well.
Spot on. Ryan, thoughts
Yeah.
there? You want to add?
So, we kind of have two buckets of capital that we're typically investing, or funds that we're investing out of. One is more traditional preferred equity, which is, kind of call it 75, 80% of cost, more of a middle of the capital stack piece. And then the other bucket is just traditional joint venture equity, where we're maybe a 90-10 partner with a local operator, or we're looking to buy out our own. On the pref equity side, we're a little bit more agnostic on market going in. Certainly we have some common equity subordination, so we have a little more risk protection, and so we'll look at really any market across the country. On the equity side, we're much more particular. We have, like others, have kind of a research-driven approach where we figure out, hey, here's the 25 markets that we want to be in. I think many of those markets continue to be generally in the Southeast, although when it comes to, we invest in all product types, but when we're talking about multifamily specifically and those fundamentals, we've actually started to see some markets, more traditional older markets in the Northeast, in the Midwest, in Mountain West states, where there hasn't been as much new supply, where the cost of living has stayed a little bit lower, and the multifamily fundamentals are very strong. So, going to Hartford, Connecticut, where we certainly probably wouldn't look at a Class B office building downtown, but in migration to some of those markets has really started to pick up again for the reasons that I just listed. So we find those pretty interesting from an equity perspective, where maybe there is a little bit of a cap rate or lack thereof on a premium we could take advantage, and we like the kind of the fundamentals over the next 3 to 5 years.
Thank you, Ryan. Let's shift a little bit to the debt markets and the availability of debt with respect to multi. I'll start it off with I think what has occurred in the last couple of years, which we won't go into, but I think everyone is aware of it, certainly in our industry with respect to the agencies, the almost unprecedented amount of scrutiny and underwriting that is being implemented and is occurring in our industry. It's touching everybody at this point. And Amy, are you seeing that on your end?
Yes. You're really the pro in this space. But yes, we are seeing that a little bit. And I think, what's going to be interesting going forward is just there's still a very big question mark over the whole capital markets environment. And I think that uncertainty is a bigger driver in this space than anything right now. I'm sure, Vic and Ryan can speak to this a little bit from a different perspective, but it seems to me like in terms of values and what's driving value and value growth, that big question mark that sits over the capital market space and the availability of debt and what kind of debt and what are the terms is going to continue to be a big driver in values as we move forward. Would you agree, Vic?
Yes, I do. And there has been some good news in the last few days, and I'll touch on that briefly. Both Fannie and Freddie have announced their budgets for 2025, both at 73 billion. So you're talking about 146 billion dollars of fresh capital coming to the market, next year, which is 3 billion each up from their budgets last year. So I think that will take some of the worry certainly out of the ability of both agencies to provide that capital. What we're dealing with is honestly an inability to a certain extent of both agencies to respond to quotes and to process with the new underwriting requirements as quickly as all of us lenders and all of us borrowers would like to see. It can take an extended amount of time to get a quote, even on a basic deal these days. But I know both Fannie and Freddie are trying to hire more people to a certain extent, like all of us, to process the business that we are seeing grow. And we are seeing the business increase substantially as acquisitions start to come back to life. But the requirements are slowing it down substantially. And what am I talking about? I'm talking about, having to, explicitly and dollar for dollar match historical financial statements that are being used to underwrite the deals to the statements that have been submitted to the servicer. I mean, there's always a trend, especially with acquisitions, where, the clients are trying to, re-underwrite expenses, saying that they can, potentially lower payrolls or lower repair and maintenance. And maybe they can. I mean, obviously, if you're buying a deal, you're hopeful that there's that type of upside. Ryan, you want to talk about that a little? You discussed, your worry a little bit with respect to value add, but that's still what the market's grasping at to a certain extent,
Yeah, I mean, I guess I kind of sit on both sides of this table sometimes. I mean, on the one hand, we, as a kind of smaller middle market investor and lender, our origination staff just sees tons of incoming deal flow in any given day. And one of the biggest challenges is going through what typically is incomplete information. And it can be a fairly long process to try to get to the bottom of where we think the numbers shake. So from our perspective, at least Fannie and Freddie, making things harder makes our job a little easier, to be honest with you. So I don't always complain about that, but at the same time, sitting with you the last few years, the lack of efficiency and lack of speed to quotes is also a problem just for transaction volume and acquisitions. And we certainly need more of that in general, in order to deploy capital at the scale that we want to. So it's a little bit of a push and a pull. Obviously, the agencies are the most efficient cost of capital for multifamily, and them being less active has certainly created more opportunities for CMBS and multifamily, and for other lenders, despite banks being kind of out of the picture to some degree compared to where they used to be. We are seeing, I think, across our platform at Northmark, opportunities for alternative lenders and things like that. So we kind of see both sides of it, but I'm certainly sympathetic to how much longer it's taking for agency transactions to kind of move through the system.
Absolutely. If there's any sellers on the call today, please be understanding with your buyers. And, in the old days, we could get a deal through the system and, sometimes as short as 30 days. Unfortunately, I think the timing is more like 60 to 90 days and even a little longer if it's a complicated deal. So, all you sellers out there, please make sure you're a little more understanding with the process. Everyone's working as hard as ever to move the deals through the system. And, my hat's off to both Fannie and Freddie for constantly trying to meet the demands of the market. And with the new budget next year, I think they'll be able to hire more people and be more responsive. But it's certainly, you're spot on, Ryan, has created a lot more opportunity for CMBS and other kind of niche lenders out there that can pick up the pace there, especially when it comes to acquisition. So, Amy, any specific thing that you'd like to kind of educate everybody on with respect to what you think 2025 will hold from your perspective?
Yeah, I think to me, the theme of 2025 is going to be business plan, business plan, business plan. We have come out of an environment where we may have all been a little bit spoiled by the really low cost of capital that we've had over the past several years. And that's not the case anymore. And what that means is that the deals that are going to really perform well and do well going forward are going to be the ones that have really sharp business plan. They've got great players involved. They've got seasoned individuals that know what they're doing and are really sharp, operating these assets, managing these assets, formulating these business plans, and enacting on these business plans. We just lost all those really wonderful margins of error that we had because the cost of capital was so low. So that would be kind of my theme of 2025, would be those who have a good, strong business plan with seasoned players are going to be the ones that come out well on the other side of 2025.
Great points. Great points. And Ryan touched on this a little bit, and I'll expand on it. With the scrutiny that we are going through now as lenders to underwrite the historical operating statements and the rent rolls and the revenue, the number of, I'm sure you've seen this, Amy, the number of lease audits that you're required to do is increasing with respect to tenant count, and pretty much everything that we always were doing, we're going to do more of. We're going to look harder at it. So by the time those numbers roll to the marketplace, for Ryan to try and make a decision on equity or pref or mezz, you probably pretty rely on those numbers because they're going to be well vetted. And I think every borrower is going to understand that. In addition to that, I think potential buyers for deals that come to the market are going to find that certainly the class B and C properties that are coming out of the agencies are going to be in better condition than we've probably ever seen, because they are looking hard and at immediate repairs, deferred maintenance, sidewalk cracks, parking lot cracks, you name it. It has become a hot topic. In the old days, you could kind of get away with, I'm not going to say do the minimum, but you could get away with doing what I'd consider a generalist approach to keeping the properties in good condition. Now, everything is being looked at and you're being required to spend money. Sometimes when you could argue that maybe that's overkill, especially for more of the mission-driven type properties. Any thoughts on that, Ryan?
Yeah, I mean, just to go back to the original question, I think, I don't think if we're talking about a real estate recovery, that might be too extreme. I think we're probably already there to some degree, but certainly it's not broad-based, in my opinion. Into the next year or so, it's market by market. Sponsors matter; they always have. But I think this last cycle has really demonstrated that again. How important it is to have a sponsor that's thorough, that's it's well capitalized, that oftentimes at least has some type of local presence. So that type of analysis and underwriting is certainly critical. And then, equity is king. It's harder to get leverage than it ever has been before. And when you're talking about, maybe distressed assets, not just multifamily, I mean, call it office or other things, you have to have equity to be able to take advantage of those opportunities. And oftentimes have to have a little bit of a longer term view, which I think historically real estate has been a longer view type investment. And I think we'll probably return a little bit more to that. And then just with debt being less, I think it gives investors like us, whether it's pref equity or JV equity, it gives us an opportunity to have more of the capital stack to be a part of. So we always kind of like that. When first mortgages are down, it means there's more of a need for kind of gap capital or larger equity checks. So that's something that we look forward to hopefully taking advantage of and deploying more money.
Amy touched on this, and this hits home with what you just said, Ryan. I mean, she mentioned rates are higher, and they definitely are. And, the economists that we're getting advice from are certainly saying that they're going to potentially stay there. Even with the Fed, lowering the rates a few months ago, and now I've got some statistics here. I think back in November, there was an 85% prediction that the Fed would cut the rate coming up here very soon by 25 basis points. And now there's only a 58% prediction that it will be cut by 25 basis points. And next year, they were predicting that there would be a total of 125 basis points worth of additional reductions in rates. And now they're saying it's possibly only going to be 75 basis points. So that bodes for continued declines. But if the Treasury follows suit of what we've seen, we may be sitting at a Treasury that we have to get used to, kind of in this 4.25 to 4.40 range. Any further thoughts on that, Amy?
Yeah, I think we all got a little spoiled by the really, really phenomenally low cost of capital that we had experienced over the last several years. And to that point, I think when I talk about business plan and business plan being king, I think a lot of that has to do with everyone adjusting their mentalities to the new norm. I think everyone had sort of hoped that, okay, we saw this spike in rates and everything's just going to kind of come back down to where it was. And I'm not sure that's the sentiment anymore. So now everyone's just repositioning and figuring out, okay, now that this is the new norm, how are we going to operate within this norm? And what is that going to look like? What does a new business plan under the new norm have to look like? So yeah, I agree.
Great. And I did a little research the other day. I was quoting a couple of deals, and the client wanted to look at the, rates on a 5, a 7, and a 10-year deal, even a 12-year deal. And, I thought it was interesting because our desk reported that spreads are honestly as tight as we have seen in a long time. So despite the somewhat increased Treasury around 440, the overall investor spreads are really at a low. So the range of rates, was literally in the, call it 5.25 up to 6% range. I know that's a pretty big range, but it covered literally the 5-year, the 7, and the 10-year deals, individually priced on their respective treasuries. But, with 5.25 to 6% rates, Ryan, deals should work at that, shouldn't they?
Well, yeah. I mean, look, I think part of it is we have to all stop worrying about what interest rates are going to be and start thinking about, do you like the investment at a basis, and do you have a time horizon that's realistic? I mean, if you're talking about a 2-year bridge loan that's high cost, that's a pretty risky position to be in. It always kind of has been. So I think having some stability where we're at now, and going into deals and underwriting a downside for your rate, and hopefully having a lender source that can lock something in to take that risk out while you're under contract obviously is important. But I mean, I think the way we look at a lot of equity opportunities right now is basis, right? And you can see that for the first time in a few years, you can start to see buying, call it older vintage multifamily, at a significant discount to replacement costs, which Vic, you mentioned, in years past, that spread had gotten pretty narrow. So that's just a big part of what anybody looks at when they're buying something, I think, or should, is what the basis is. And there's been more and more opportunities to buy at something that looks like an attractive long-term basis.
Ryan, you've always been a smart guy. You speak well, and I want to recall a meeting I was in probably 4 or 5 years ago in what I call the heyday of acquisitions, and I won't mention the client because I'll probably never get to do business with them, but I'll never forget, they were pretty young and they said, we don't care what the basis is, Vic. We don't care what the price per unit is, as long as we can financially engineer the numbers to work to provide our investors the return. And that was the precise moment I knew we were headed for real trouble, because people were paying in Texas, the $150,000 a unit for a 1970s product that
right.
I had probably financed 30 years earlier and was worried about the loan when I put 27,000 a unit in debt on it. And they're asking me to put about 140 a door in debt. I'm thinking, can't we build this stuff for 175 excluding the land? So, what would I rather be sitting on, a 60, 70-year-old property potentially at a similar price than just building brand new? And I think to a certain extent that pushed a lot of equity into new construction back in those days. And Amy, any thoughts? I'm sure y'all saw that as well. And talk about basis. I mean, y'all do the cost approach on every deal. And what are you seeing?
We did. We saw a lot of that where we saw B/C deals really kind of barreling towards cost basis, and that is a little scary to think about, especially in markets where new construction is feasible and there are not high barriers to entry. Most of the Sun Belt markets don't have massive barriers to entry, and so new construction is very feasible. We did see a lot of that, and I think that's what we're seeing now. Where we're sitting now is all that new construction that was done, back when, values are really growing rapidly, is hitting the market. It's going to take a minute for us to absorb all of that. I will say a lot of the new construction deals that we are looking at now, the margins are very thin. It's not easy to make financial sense right now. And there are a decent amount of new starts that are just holding off right now because, when you start looking at, the parameters for construction debt, and where value metrics are sitting and cap rates are sitting right now, they just don't pencil. And so I do think that we're going to see that alleviate a little bit as some time passes and we get back to a period of better rent growth. But yeah, I think that that there was definitely a mindset of, we don't care what we're paying, we just care that we're making money. And that's a really short-term mindset. To Ryan's point, I think we're going to start seeing kind of more the traditional longer term holds. Used to be that really kind of 5+ years, really almost 7+ years was considered a more traditional hold period for a multifamily asset. But over the last several years, 2020 to present, I think a lot of investors have been thinking in kind of 2 to 5 year hold periods. I think the time for that has kind of come to a close. A lot of that has to do with cost of capital, and we were in a period where values were really rapidly rising, and it made for a really profitable flip environment. But I don't think that we're in that environment anymore. We could argue, we could sit here and debate, was that even a healthy environment? Maybe yes, maybe not. I'm sure plenty of people made some really great money during those years. However, was that healthy for the market? Probably not. So I think we're readjusting to a little bit more of a healthy perspective on investments with a longer hold period, more thoughtful, thoughtful purchase metrics, that initial basis, and more thoughtful, business plan over a longer term hold.
Well said. Well said, Amy. Ryan, in line with that, what do you think are the opportunities over the next 6 months in the marketplace? Are you seeing good flow of deals that make sense as an investment? Is there stress in the marketplace from your perspective?
That's a good question. Obviously, it's hard to answer specifically, where I guess I think the equity opportunities are. Multifamily, we're seeing more legitimate requests for capital where senior lenders are either open to DPOing a loan or are basically selling. They're kind of coming in and selling the asset at their loan basis, especially in some of the Sunbelt markets where bridge lenders, it's maybe been 2 or 3 years into loan extensions, and that period's kind of ending. And I think there were probably more syndicated deals, highly levered deals in some of those markets. So we're certainly seeing, especially the older vintage stuff, opportunities where new astute operators are coming in and saying, "Hey, this bridge loan is at $30 million. The existing owner is pretty much out of the money, probably not putting in new capital, and is trying to facilitate a lender sale." And so those are always interesting opportunities to look at. Doesn't necessarily mean that there are deals, and sometimes they don't need enough equity. Frankly, if you can buy something at the loan balance, you're inherently very highly levered going in, which might not be a bad opportunity, but doesn't necessarily leave a lot of room for an institutional partner. And then outside multifamily, I mean, we have been office investors as part of our portfolio historically. We're definitely much more skeptical on new office investments, but I'm sure everyone's seen headlines in particular markets about things trading at dramatic discounts to either replacement costs or where the value or purchase price was a few years ago. So I think there's opportunity there, especially for folks that have a lot of equity. I mean, office is pretty hard to finance. And then it's market by market, it's deal by deal. There's certainly places where there's strong in-migration and economic growth, and those are the places that we're targeting more than anything for the equity.
Thank you, Ryan. The volatility in the market has kind of been the topic, around our office cooler, if you will. I mean, when we've gone from, I think the lowest I saw was a 368 10-year treasury all the way back up to 440 in just literally a matter of weeks. It puts a lot of stress on the deals that are being processed and in the system. And I've actually seen, despite the increase in delicateness, if you will, of the investment sales market, that clients who put deals under app a few months ago that are trying to close in this kind of slow close environment have been put in a position where what they thought they could get is substantially different than what is actually going to be delivered when they close the loan, just because of literally a 70 basis point increase in rates that we're all trying to navigate. So they have literally gone back or are going back to the sellers and asking for discounts on those prices that were negotiated, say in August, September, October, because now here we are in middle of November and it doesn't look like we're going to get the relief we were expecting. Amy, are you seeing that as well?
Yeah, I'm definitely seeing the same thing. I think I'm actually sitting here reading the comments. Mark has a really interesting question about the likelihood of Fannie and Freddie having to ask for bailouts. They have put out a lot of really strong policy changes around fraud prevention and some other things. I'd love to hear, Vic, your perspective too on how you think the agencies are holding up. My perspective as just somebody who sees a lot of agency transactions has been that fraud is really pretty uncommon. But after some pointed incidents of it over the last couple of years, they are being really careful to prevent it going forward. My perspective on the agencies would be that a lot of this is sort of abundance of caution, which is a good thing. And I think given the environment that we're in, where margins are thinner, there's just less room for error on these deals. That they're being more careful in their lending decisions. So, do I think we're barreling towards a 2008, subprime kind of bubble in the multifamily space? I don't think so. But I think it's an interesting question. I think that's actually what they're trying to prevent in all these new measures. Vic, do you have any thoughts on that?
You're 100% spot on, Amy. They're trying to prevent it. They're trying to make sure, even for the 30-year plus best customers of both Fannie and Freddie, they're cracking down on deferred maintenance, because that's typically where the value declines the quickest. If they have to take a deal back, if the properties can, especially on some of the more affordable properties, because of sometimes the turnover, and they can decline quickly. Let's just say that. And if you don't keep your eye on the ball, which, let's face it, Fannie and Freddie, their eyes are laser focused on the ball right now to make sure that the quality of these assets is maintained. And to a certain extent, that allows them to define who are going to be the successful borrowers moving forward. Because if you do not respond the way they want you to respond, they are not going to lend you any more money. And that's going to put you at a huge disadvantage in the marketplace. So you're spot on there, Amy. I think if we can give advice to the folks out there, it's keep your properties nice, communicate often, and honestly. Amy, you touched on some of the issues, the fraud that has been in the industry. I don't think it is, by any stretch of the imagination, it has been what I'd considered rampant. It has been a few bad apples who probably were doing it for way too long, and they finally got caught. And as a lender who's always tried to do the right thing, I'm glad they got caught, and I'm glad we're going through this process, because it evens the playing field for all of us who are doing the right thing. And no one, when we're talking about agency business, in my personal opinion, given that it's government subsidized, no one should have an overwhelming advantage. And that advantage was caused by doing the wrong thing. So I hope those groups are punished substantially. Let's see. Do we have any other questions we want to jump into? Or I think we're down to about 5 minutes here. So
well, Mark, to your point, I think the agencies are in less trouble than maybe some of the bridge lenders out there. You're right that I understand what you're saying when you say the damage is already done. Yes, there are a lot of loans that were done in 2020 through 2022. I think the ones that we should be keeping a closer eye on would be the short-term bridge lending that was done during that time period, rather than the agency financing that was done during that time period. I think those are the risk profile on those loans is very different than agency loans.
And I know you were close to a lot of bridge lending as well. You agree?
Yeah, I think they're kind of two different issues. I think our questions, Mark's question, I agree with. To what you guys are saying, I don't think the scale of the issue is anything that gets to a bailout type thing. And remember that the lending partners that sell these loans to the agencies are going to have some responsibility, and some of these loans are going to be put back to them. There's the loss share And, multifamily in some markets, is it down 20 or 30%? It's not down 80%. I mean, so even some of these impaired loans, whether it was fraudulent underwriting or not, I don't know that it's to the extent that you're going to have some type of bailout. I certainly do think there's more distress on the bridge side. Inherently they were higher leverage loans, and many times they were floating and didn't have perfect interest rate hedges or protection. And that more than anything is these assets just can't service the debt. I think part of the issue for the bridge loans is they need to be comfortable that they have a borrower and an owner that's still taking care of the asset. I think what can happen if you're not paying attention, or if you let a borrower without capital continue asset, multifamily might be a passive investment for some equity folks, but it's certainly not a passive investment to own and operate. And I think that's where some of the bridge lenders may have issues, is if they wait too long to figure something out, or put pressure on a borrower to take an asset back, because something that's worth $20 million, if it's 75% leased with a bunch of deferred maintenance, that's much harder to come back from. So
I fully agree with Mark too. I think it is going to come to a head between now and the end of 2025, because I think a lot of lenders have extended as long as they're willing to extend. But at the same time, I think a lot of those bridge lenders are prepared to take those assets back and operate them themselves. They don't want to, they really don't. So if they think they can sell it for the debt, they'll probably sell it for the debt and work with their investment sales groups to move those assets. But, as a lender, if you're sitting there looking at taking a $5 million hit on one loan, and you think there's continued upside in the marketplace that it's in, you're going to become an operator for a while. You're not going to jump quickly to take that kind of a loss. So, and it was, in my opinion, aggressive underwriting, Mark, as you just kind of commented on. But when you couple aggressive underwriting with, fraud that did exist, it's a double whammy. So those groups that did that, they will suffer for sure. And in my opinion, that's going to create a lot of buying opportunity towards the end and all the way through next year. So keep your money. Get ready. There's going to be some opportunities, but I don't see it being so widespread in the market rate and mission driven business. I think where a lot of the distress is more, I'm going to say it, healthcare related, in some of the assets where maybe it was a agency originated assisted living facility or 55 and up, where those deals take longer to lease up, they're more expensive to operate, the payrolls are higher, et cetera, et cetera. So they took a harder hit than your typical market or mission deal, just because you can't replace those payrolls as easily as you can in a typical multifamily deal. And those assets are typically of high quality, typically. So, they have a long way to drop when it comes to rent. So that's where the last time I heard significant stress on the agency side, and I think we see it because we are a big healthcare lender, is in that sector. Let's see. We are right at an hour. Any other questions out there? Let's see. I don't see any other questions that we can quickly jump into, but any final thoughts, Ryan? Any advice to the listeners?
No, I don't think I'm in a position to give advice. I think there'll be more opportunity in 2025 and probably 24, and hopefully there's some continuity on the rate environment and kind of picks up transactions a little bit. But other than that, no, I appreciate, Vic, you inviting me to the call today, and nice talking with Amy as well.
Amy, your last thoughts. Any advice?
Yeah, I think, again, business plan, business plan, business plan. have seasoned professionals, rely on third-party experts like appraisers and consultants who have experience in the industry, folks like Vic who have deep experience in the debt space, folks like Ryan who have deep experience on the ownership and equity side. Use the resources that are around you. I think opportunity will continue to be there in 2025. It just looks different than it used to. So I think we're all adjusting to what opportunity looks like now.
Well said. Well said. Well, thank you both. Always a pleasure working with you guys. I highly recommend both of these individuals to any of our callers. They're the best at what they do. And thank you to Crittenden for continuing to keep us all educated and keep us all connecting. And we look forward to a great year end, trying to close as many deals as we can. And I think there's a lot of opportunity coming in 2025. So thank you guys. Y'all take care.
Thank you.
Thanks, everybody.